There is a buyer in the gold market right now, bigger than every hedge fund on earth combined. It does not care about quarterly returns. It has never once panic sold during a drawdown. It has bought through wars, through rate hikes, through every headline telling investors that gold was dead money. And it just bought more. I want to show you exactly who this buyer is, why it is buying at a pace we have never seen before in modern financial history, and what that pattern has historically meant for the price of gold in the years that follow. By the end of this video, you will understand why the most important force in the gold market right now has nothing to do with retail investors, nothing to do with Wall Street, and everything to do with a decision being made quietly, deliberately, inside the walls of central banks around the world. Welcome back to Gold and Silver Analysts. If you want to understand what actually moves these markets, not the noise, the real mechanics, hit subscribe, because that is exactly what we do here every single week. Let's start with the number that should stop you cold. Central banks purchased more than 1,000 tons of gold annually for 3 consecutive years, a level of buying that has no precedent in the modern era of central banking. Before that stretch began, annual central bank purchases had averaged a fraction of that amount for decades. Something changed, and once you understand what changed, you will never read a central bank gold report the same way again. Here is the mechanism step by step, because until you understand this, nothing else about the gold market makes sense. Step 1. In 2022, the United States and its allies froze roughly $300 billion in Russian central bank reserves in response to the invasion of Ukraine. Step 2. That single action proved something to every government on earth that had never been proven so explicitly before. Dollar reserves held in Western financial institutions are not unconditionally safe. They can be frozen, they can be seized, they can be turned into a weapon of foreign policy. Step 3. Every central bank on the planet, ally and adversary alike, received that message simultaneously, whether they wanted to or not. Step 4. The logical response to a reserve asset that can be confiscated is to diversify into a reserve asset that cannot be. Physical gold, held domestically, cannot be frozen by a foreign government. It cannot be sanctioned. It cannot be deleted with a keystroke. Step 5. That is precisely what we have watched happen ever since, a structural sustained rotation out of dollar-denominated reserves and into physical gold at a pace that keeps surprising the very analysts paid to forecast it. Now let's look at who specifically is doing this buying, because the pattern is not random. China's central bank has added to its official gold reserves in a steady, monthly pattern that has continued for well over 2 years. Institutions do not behave that way by accident. 2 years of consistent monthly purchases is not a trading position. It is a strategic reallocation. Russia has been building its gold reserves for over a decade, understanding earlier than almost anyone the vulnerability that dollar-denominated assets carried. And now the list has grown far beyond the countries you would expect: Poland, Hungary, India, Turkey, countries across the emerging world, each one making a similar calculation independently, and yet arriving at the same conclusion at roughly the same time. That is not coincidence. That is coordination happening in plain sight, without a meeting, without an announcement, simply because the underlying incentive is identical for all of them. Here is what almost nobody in mainstream financial media points out clearly enough. Central banks are the institutions that issue currency. They are, by definition, the entities the entire fiat system depends on projecting confidence in paper money. When the institutions responsible for defending the credibility of currency start quietly moving their own reserves into the asset that currency was originally designed to replace, that is not a routine portfolio adjustment. That is a signal, and it may be the clearest signal available right now about where the people who actually understand the plumbing of the global financial system believe things are heading. Let's talk about why this matters so much more than retail buying or even hedge fund positioning. When a hedge fund buys gold, it is making a bet, a trade with an exit strategy, a stop loss, a time horizon measured in months or quarters. When a central bank buys gold, there is no exit strategy. There is no quarterly earnings call to satisfy. These purchases are not driven by a view on next month's CPI print. They are driven by a multi-decade view on the credibility of the dollar-based reserve system itself. That is a fundamentally different kind of buyer, with a fundamentally different kind of conviction, and it behaves in a fundamentally different way during price drawdowns. Retail investors sell when gold falls 15% in a month. Central banks do not. In my years of watching this pattern, I have never once seen a central bank dump reserves because gold had a red month. They are not trading. They are repositioning the foundation. So what does this structural buying actually do to price over time? It puts a persistent bid underneath the market that did not meaningfully exist a decade ago. Think of it as a floor that keeps rising, independent of what retail sentiment is doing on any given week. Every ounce a central bank absorbs is an ounce that is not coming back into circulation, not being traded, not adding to available supply. When that kind of buying runs alongside private institutional demand, alongside a debt environment where governments are structurally incentivized to see currencies weaken over time, you get a demand base that is both larger and stickier than anything the gold market has had to absorb in the modern era. Now, I want to be honest about the other side of this because a fair breakdown has to hold both realities. Central bank buying can slow. It has slowed before, after sharp price rallies, as some buyers pause to reassess. Gold prices can and do correct sharply, even while this structural buying continues underneath the surface, because short-term price is still driven by yields, by the dollar, by speculative futures positioning, forces that can push against the central bank bid for months at a time. This is not a story where the price only goes up in a straight line. It never has been. But the structural floor is a different thing entirely from the short-term ceiling. And confusing the two is exactly how investors talk themselves out of a position at precisely the wrong moment. Here is the question I want you to sit with. If the institutions that print money are quietly moving their own reserves into the one asset that was originally designed to constrain them, what does that tell you about how much confidence they actually have in the system they are running? You do not need to believe in gold philosophically to find that question uncomfortable. You just need to understand what these institutions are actually doing with their own balance sheets, as opposed to what they are saying in public. There are two types of investors watching this pattern unfold right now. The first type sees a red month in gold and concludes the buying story must be overstated. The second type understands that the buyer in question has no earnings call to answer to, no quarter to justify, and has been accumulating steadily through every single drawdown of the last several years. I have watched this pattern for a long time, and I know which type of investor tends to still be holding when the structural floor finally becomes visible to everyone else. If this gave you a clearer picture of who is actually moving this market, hit subscribe to Gold and Silver Analysts, because we track the central bank buying data, the reserve reports, and what the smart money is doing with it every single week, and you do not want to be the last one to notice. I'll see you in the next one.